Hello, I'm Mario Toneguzzi, managing editor of Canada's podcast, taking care of business today with Simon Gaudreault, who is Canadian Federation of Independent Businesses chief economist and vice president of research. Thanks, Simon, for joining us today.
Thank you for having me, Mario.
All right, let's talk about the recent Main Street quarterly report that you folks put out looking at the Canadian economy. Mentions that we can expect a slowdown this year, but no recession, which is the big word everybody wants to use. Tell us what you guys are forecasting for this year.
Yeah, and I think the first important thing we should say right from the start is we do not do long-term forecasts. So the forecasts that we provide are for the first half of 2023.
Yeah.
And what we're seeing, based on the latest numbers that were released about actual economic growth by StatCan and our outlook for the first half of this year, we're still out of the recession territory, at least for the first half of this year. That's good news. However, we do forecast a slowdown in the economy. There will be economic growth, but it will be quite slow. We actually forecast it for the second quarter of this year to be close to the 1% growth rate, which is lower than what we're used to see for the Canadian economy in more normal economic times.
Tell me, Simon, what are some of the key factors that are contributing to or will contribute to the slowdown here in the economy?
Well, certainly the Bank of Canada raising interest rates at an unprecedented rate in at least for the past several decades has contributed to the slowdown. We know, for example, that small business owners are exposed to variable rates, perhaps more than the average Canadian. In a previous survey we did with our members a few years ago, close to 2/3 said they had some sort of loan on variable rates. So certainly they feel the pain very quickly. Those listeners and that from the podcast will relate if they have a mortgage on variable rate. And actually also you have this entire residential, non-residential real estate sector that is feeling the pain right now. So that's contributing to a slowing economy. And as Canadian need to funnel more of their money into mortgage payments, there is less left to pay for goods and services. So all of that is slowing the economy. That's why we're forecasting a slower rate of economic growth for the rest of the year.
What does that all mean for the labor market in Canada? You know, on the one hand, we're seeing, what you're saying, a slowing down of the economy, but yet we keep hearing from everybody that there's a labor shortage and in certain industries, they can't find people. What do you expect is going to happen with the labor market here in the coming months?
Yeah, so we forecast that employment is going to continue to grow in the coming months. Employment has been strong, perhaps even stronger than what most analysts expected. That's even a worry for the Bank of Canada, because if businesses demand more workers and the supply is not there to meet it, it will put upward pressure on wages. That will in turn fuel inflation. So that's something that we'll have to watch closely. However, what we're seeing with our estimates of job vacancies in the private sector, we're updating those estimates in the same report that we've been discussing. For the first quarter of this year, you had 650, close to 59,000 jobs that were vacant for at least 3 or 4 months because employers couldn't find suitable candidates. Just to put things into perspective, before the pandemic, we were saying, oh, we've reached unprecedented level of job vacancies. It's historically high. It was about 400, 450,000 before the pandemic. Now we've almost added 50% to that total. Back in the days, we were already saying that it was a concerning situation. So imagine right now, we are in a situation where it's unprecedented pressure on employers to find candidates. However, it seems like if you look at the share of vacant jobs as a total of all jobs in the economy, that vacancy rate, it has stabilized to a certain extent in recent quarters. So that's the bit of good news. It seems like the labor shortages issue is still very acute. However, it is not deteriorating as fast as it was in the past. So in other words, the patient is still in critical condition, but it has stabilized to a certain extent. So that's how I would put it.
So let me ask you just, one of the key issues that businesses have faced over the last few years of the whole supply chain network. What do you see happening there? Are we kind of past some of the issues that we've had?
Very good question, Mario, and thanks for asking it, because the perspective that we're getting right now from certain analysts is that the supply chain issue is entirely resolved, that the global supply chain pressure indicators are back to normal, back to where they were before the pandemic. Actually, at CFIB, with our Business Barometer monthly survey that we're doing, we're seeing that the share of businesses showing, saying that they have issues with getting inputs is at 17% right now. It is still double what it was in normal times before the pandemic. So from our point of view, and at least for small businesses, medium-sized businesses, supply chain issues, unfortunately, are not entirely resolved. It has gone down significantly. That 17% must be put into relation with a peak that was almost 30% at the height of the pandemic, even above 30%. But there is still some way to go before we go back to the usual share of businesses that report supply chain issues. It's still more of a problem than it was before 2020.
All right. Thank you, Simon, for joining us today.
Thank you so much.
All right. That was Simon Gaudreault, who is Chief Economist and Vice President of Research for the Canadian Federation of Independent Business. I'm Mario Toneguzzi, Managing Editor of Canada's podcast, Taking Care of Business Today. Thanks for joining us today.